Where he's finding opportunity right now, let's bring in noted value investor, Oakmark Funds portfolio manager, Bill Nygren. Bill, welcome back to the show. The whole notion of value versus growth kind of has been scrambled lately. There were high hopes for value, and then now some questions about growth into next year. How do you think that age-old battle is going to shake out next year?
Well, at Oakmark, we think really long-term. And you look back over the past decade, it has been a great decade for growth stocks. And that's not so much because their fundamental performance has been so much better than inexpensive stocks. It's because their PEs have expanded. So you see the S&P 500 today selling at something over 20 times next year's earnings. But there aren't a lot of stocks at 20 times earnings. There are a lot that are over 50 times. And then there are a bunch of them that are down around 10 times. So at Oakmark, we're anticipating that growth stocks multiples will come down a little bit, and that the low PE stocks provide very good hunting ground for long-term investors today.
So give us some examples, some names that you see that.
Sure. One of our largest holdings in Oakmark is Ally Financial. Ally stock sells in the upper 40s. Consensus earnings for next year are over $7. So you're talking about a PE under 7 times. They're the leading auto lender. Most of the large banks have moved away from anything except prime customers. So margins have gotten better for Ally. Ally trades at about next year's tangible book value. We think it's an incredible opportunity at this price. They're very aggressively repurchasing shares. Another company, Charter Communications. Stock's down almost 200 points from its high earlier this year. It doesn't look super cheap on an EPS basis, but that's because non-cash amortization goes through their income statement. If you add back that amortization, it's selling at less than 15 times earnings. We think of it as an infrastructure play. I think it should sell at a multiple more like the other infrastructure companies, or cell phone tower companies, and those trade at twice the market multiple. So those are a couple examples of where we think people have walked away from really attractive situations this year.
Walked away from Charter in part because there's concern about overbuilders. There's concern about their ability to obviously add subscribers at anywhere near the rate they had previously when the stock was obviously responding quite positively. Bill, you don't share those concerns about, let's just put it simply, sort of increased competition for what they do?
Sure. In terms of the subscribers, David, I think everybody realizes that there was a pull forward during the COVID lockdowns, and nobody really expected them to maintain those rates. But we think, if you look at the 2-year or 3-year stack subscriber growth on internet subscribers, not video, is still very strong. And we think the companies are advantaged enough that the wireless Wi-Fi is not going to be a solution for people. We think there'll be limited competition for wired Wi-Fi.